Yep, guys, how are you? Yes, reset sniper time. Whoa, there he is, standing on the logo, the Marco sniper, the crypto sniper, and the great reset sniper. And boy, is it getting hot out there in reset land. Chuckle, chuckle. Yeah, anyway, so I've given you a big, crazy FX move. I also slipped in as a little part slide USD JPY. I always like to give you a bonus. This series of YouTube clips is my pre-current early stage reset trades that could help you fly into our community, paid out of any one single of these trades, plus have your memberships for 10 years and bought a new car, depending on what size you go in. So that's the idea anyway. Of course, this is entertainment. It's not a recommendation. You know that. I say it anyway. Okay, so I'm bringing you to another industry I most like to hate, and that is financial services, US, especially ones involved in corporate debt. I did sneak this one out. We have been doing it and playing it and squeezing it and jamming it in our premium area. So you're getting a sneak preview of the couple of the things that we've done. And you'll get roughly, even though I said 3 trades, all in all, you might get 5 little ideas out of there, because I like to slip a little bonus in and be generous and kind. And we've made a virtual handshake to see you on the other side once you've aced one of these trades. Anyway, let's talk about this. Wells Fargo, WFC. I let this one slip on Twitter a while back, that on the high side of these little rallies, I am actually capturing myself some of short positions in this here stock. So let's talk about it, and I'm going to do something a little bit different. I'm going to just fly past. I'm not interested in doing the full-blown equity analyst and doing the fundamentals and the balance sheet stuff. I think that's dry and boring. I always assess that the technicals will give you the heads up. But there are some interesting things about financial services generally the world over. So I've got a short Barclays. It's making money. It's on the profit side. We called for Deutsche Bank since long before everyone else crowded that trade out. And it's busy setting up new short time frame setups. Every now and then I watch them and I'll give you a little bump on one of them, or we've been taking them in the community. You maybe not heard about them all, and you get little inverted setups, more downside. Go have a little look see right now. The little reset napalm whiff in the air brings dirty banker blood to the oil slicky surface. Yes, indeed. So have a little wee look at this one. But we're talking about Wells, but generally the overall category, not doing well. Flattening yield curve. So they borrow long and they sometimes lend out short. It's a problem for their margins. Or they're borrowing short and lending out long, depending on where you're getting your funding. But when it starts to flatten, there's no margin in terms of bank profitability. In other words, the spread at which they get money provided to them and what they get to charge you. So that's a general thing, and it's very, very ugly for banks. It's not a good position. So overall, retail banks stink generally as a category. Then we take a look at the US retail banks, and nobody likes to blow up a good old consumer credit bubble like made apple pie home in the good old USA. Yes, sirree. Nobody does credit and jam in their bond. Half the people don't know what they pay for something. They just want to know, what's my payment, man? What's my payment? I was over there. Look, love the US guys. This is not mocking you. All my fans that watch in the US, always awesome to visit and meet and see them. Plenty of smart people. But overall, there is a large mass that is unsophisticated lenders that just care if they can afford a payment and assume that they'll have the same job with the same income and be able to run with it. This is a place where you get up to 7-year car loans and you're not even paying for the whole vehicle. You might be paying for just half of it. This is where you get a house loan. My old man retired his mortgage on the house faster than these guys are paying their car off, and paid a whole bunch less interest for it as well. So this is the land of subprime auto. So let's have a little look-see here. Wells is a great old player in auto. In fact, it's trimming its auto loans book. Trim. Neat little pair of scissors, making nice round the fringes, ignoring the fact that it is huge. Yep, the market cools and risk overall is kicking in. By the way, on autos, sidebar, separate point, overproduction, too many big nations that got to have an auto champion. China's going to want one. Korea has two in Kia and Hyundai. There's overproduction of cars for buying. Check Tesla's super cool, so fast, battery specials. They ain't selling. VW Group in slow. BMW slow. The autos, there's overproduction. There's not enough consumption. And those that took the shotgun finance in the last 5-10 years of reflation since 08 lows on the shady deals and the reflation, we've created a whole new subprime category. Subprime autos. Yes, a new asset class, only it isn't really an asset. It's it's like a printer. It's a hectically depreciating asset, and it probably drops 20, 25, 30% depending on the brand of car you buy in the first 18 months to 3 years. So this is in an environment where the dollar is falling through the floor, so you're comparing it to something that's losing value, and it's still losing 30% against that. That's not in gold units, by the way, real money. But so subprime autos, Wells is a big player in it. It's scaling back its auto lending business in response to growing stress in the market and a desire for more centralized risk controls. Oh, really? What's wrong with your risk profile? What's been happening? Was the number 2 US provider of auto loans 2 years. So you're talking about the second biggest slice of the subprime auto loan book of America. What could go wrong there? Yes, sirree. Auto loans, and they've got a big smelly pig snout in that trough, slurping it all up, and that is going to get real bitter and sour in their bellies right now, and they're hauling back, they're reining back, and this is going to be the classic case of too little too late, so that the guy who's currently in charge says, hey, I've been doing the right things, but all the paths were laid for the major thing. What about students? Let's talk about student loans. That's another subprime fave. Go and do that 120 grand. Yep, they'll do up to 120 grand. Oh, by the way, no specified FICA credit score required for approval. Loans applications are evaluated on a case-by-case basis. Now, student loans are a little bit different. Apparently, you can't bankrupt your way out of them. They will follow you forever. That might be part of the government trying to get the banks to play ball and give them a sort of backstop. But nonetheless, I suspect having a large portfolio of underperforming loans is time costly. It certainly kills margins, and even if they can't write off the debt and it's going to follow them forever, doing collections and everything, who knows? There may well be debt forgiveness, and someone's going to have to bail these banks. So we saw talking about Wells, a big player in auto loans, a big player in subprime student loans, in a flattening yield curve environment that's affecting the entire industry. So they are fat ass pig in all the worst troughs. And then there was the scandals. So they were apparently highly rated, and you'll see from the chart, I'm going to throw up a little, before I get knees deep into the scandals, I'm going to throw up a little compare for you here. Let's go grab Bank of America, for example. Now, most of these banks I wouldn't touch with a barge pole, including this one. So it's by no means a strong benchmark. I consider it largely bust, like most of the other consumer retail banks. But let's just ignore my opinions there for now, and see the difference in performance. You see, Wells Fargo had a stellar reputation for returns on equity. In fact, Warren Buffett was pretty deep in them, and I'll be coming to our friend Wazza, the financial legend, in a minute. And he, in fact, has been divesting out of Wells. He sold a whole bunch of Wells. And in actual fact, more recently, he has nibbled at Bank of America while refusing to top up his Wells Fargo stake. So somebody with big eyes does not see relative strength in the current price levels of these two charts. And what you might notice, he says, reaching for his pen, searching far and wide, and grabbing his lovely bag of tricks to impress you with the razzle and the dazzle of his commitment to give you awe-inspiring videos highlighting his point. What you might notice here is, if we take the orange pen here, that was Bank of America's high there, and this was their subprime low. Now you might notice, in terms of Wells, that was a far more volatile sell-off. If you want to know the values, you would have been in at $54 and you were coming out at about $6. Hello there. Next lady for a shave. That was such a deep shave that you lost your head in that one. Anyway, so that was a proper hit, while in percentage terms you can see quite clearly that Wells was not on the same level. And subsequent to the subprime, Wells went and made new highs, while Bank of America is barely recovered 50% of that capitulation. And in fact, at its current price, with financials stinking up the room, a fart box in pawpaw season, 27.62, right the way from 54. It's still only half what it was at the highs, whilst Wells in the meantime has gone from 45, 42-esque up to 65 at its highest point, and is only now back on, and we'll get to the technical elements in a minute. But I wanted you just to see the difference in relative valuation that an overrated Wells Fargo's had, because subsequently it has become rather interesting, the narrative that has followed it, which has been the fakery that went on. What do I mean by fakery? Well, you see, little old Wells, to keep their sales numbers looking good, they pressurized their staff so much that the staff started to cheat. Relentless pressure to sell has battered employee morale and led to ethical breaches. We saw this in UK banks. I had first insight on this. Everyone had to continually try peddle you something. You just wanted to get your banking done, and you ended up getting sales pitch a minute because you popped in. Well, Wells was the forerunner for that, and lots of consumer financial protection that was done. 2 million deposit and credit card accounts that consumers had not wanted were opened for them. Isn't that nice? You get a new bank account, and a new credit card you never even knew you had was opened and sent, and well done. New accounts made, and new charges on your new card, and you've immediately got a credit balance, and you now have interest to pay because you had that fee for that product you never ordered added into your thing. That's kind of interesting. It's not very consumer driven, is it? It's rather supply driven. Here, you shall eat. Kind of take that goose and spoon feed him that meal he loves so much that he's choking. Yep, kind of a little bit like that. So this is the history. So they went through 2 CEOs in the space of 3 years, guys. 2 CEOs in the space of 3 years. That's what's been going on. Board of directors changed, board of directors thrown out, compensation reined back, ongoing saga, 110 million agreement to settle a class action suit, then extending it even further back to 2002. You know, the turd ball that they discovered underground kept growing bigger, you know, and they suddenly realized they were sitting on an entire fertilizer factory once they started scratching below the levels there. So you've got a bank that reputationally was an aggressive squeeze timeshare sales box that went so far that people began to cheat just to give their bosses what they wanted, regardless of the repercussions, including filling out applications for products that people had never applied for. You've got to be pretty far gone to want to give people numbers they want to hear in a manner to do something like that. So the list of sagas just goes on and on and on in terms of this bank. So here you have loss of reputation, cookery, new CEOs, one back to back. You don't get to get your vision kicking off in a year. You barely got your feet under the table with these big organizations in a single year. There's no vision, there's no sustainability, there's no development of the bank and one strong leader established. They had to get rid of CEO and chairman roles, all sorts of restructuring. So they now have a Fed-based asset cap. They may not grow any larger. They've got the rev restrictor. You might have had an ex-Corvette muscle car and it's not allowed to rev more than 2,000 revs. Why? The Fed has said, we want to see your internal controls back. So the cops have actually put a rev restrictor on them and said your asset book and value may not grow. They're told to flatline. You've got the likes of Waza. Let's go back to our friend Waza, buying Bank of America stock over Wells. You can go read all about it. Plus, he reduced his own Wells and Fargo holdings, as I've already mentioned. So these are some of the fundamental facts. Let's take you in technically, because this is just part of the narrative. You guys love a narrative, but I'm going to give you the technical lowdown as well. We can even throw in here another probably bust bank for the love and fun of it. What about Citibank? Slightly different, more international as a bank, and credit card focused, but still it's interesting nonetheless. Citigroup, let's have a look at him. That's the Citigroup stock relative to the Bank of America. I did something dumb and stupid there. I wanted all three on there. So we'll get our friend Wells back, but you can see that Citi is flatlining. It's making Bank of America look like a shooting star with that return move that it's had. So Citibank, a proper America's equivalent of Deutsche. So you can see what a rating Wells Fargo relatively appeared to have had up until this point. Now let's have a look a little further. I've got my old chart back. I'm happy with that. Let's see. Try one more time in case I'll cock it up. Let's say what Citi. Can we get Citibank on there without? That's what I meant to do. There you go. Now you know. That is the low of the low, and as I say, it's America's version of Deutsche Bank. Citibank is as dead as a dodo in my view. But anyway, let's get those lines up that I like to draw. Look at this performance, by the way, of financial services, though, generally. This was the financialization of everything. The go from the 80s, deep from the 90s, through all the way into the subprime crisis, and then this particular equity apparently defied it. Let's have a look now at how it is set up technically, and for that I will in fact take these other lines off because that's going to get a little bit rude and messy. You can see the relative strength that Wells has been afforded. Now you might look at this and say, interesting, I have something to say about that. And if you were of the mind to say Francis Head and Shoulders, you would be pretty accurate. So that would be a left. We'd call that a falling wedge, ... into a breakup. That then gives you a smaller head and shoulder there, which already has a neckline break, which has already been held on a return move. Plus that as a left shoulder, with this as micro left shoulder, that as micro head, that as micro right shoulder, and this weak effort here for me as macro right shoulder. So that actually means we have a monarch head and shoulders. You'll learn about that. King's crown and all that. Yes, sirree. There's the king's crown. The first and bigger, the first and highest. And you have nestled head and shoulders with a larger head and shoulder in play here. So that gives you some seriously big necklines. That's down to there. That's also well on the way if these targets are met. But do we just trade reversals and necklines? No, sir, we do not. So let's take that off and let's talk a little bit more technical turkey with you. How about we open up that eye and let you see some of the lines I've drawn. So there's that rising wedge, spills into a falling wedge, spills into a falling wedge, neckline, key round number, $45. Hit me with a 45. Yep, bang up, another falling wedge. What do you get? Break upside. You get the wind up. You get your absolute blow off spit right to the 66 mark. Aren't we flying high? Aren't we flying high? Look at the selling that came on that gap. You would expect that there may well have been. By the way, this is where you can put your earnings on in case you guys do not know. And you would have got earnings there and everyone got real excited by it. And then they read the detail and they didn't like it so much. So I will take the earnings off, apart from warning you that the next earnings announcement is not that far away, 14th of October. This matters, guys. This matters. The fundamentals drive the technicals. The technicals will show you which direction the fundamentals are going. They work hand in hand, and you will get triggering events on the 14th of October potentially. What does the market and the insiders know? What are they illustrating? I have the volume on here as well. It's helpful, but it sometimes hides the key targets. So head and shoulders targets, we only do HVF method head and shoulders with horizontal lines. Key levels of significance are the most important thing. That was 50 and 50 cents. That was a little first inverted in a new trend that was made. You rallied, you got another grinding little setup. That was a rising wedge. You spilled, you triggered that neckline, which is over there. So that is already in a break. It rallied up to that neckline. As a typical with key levels of significance, it's just run and fails through it. Back down, it's playing footsie with the 45. It's playing footsie with the 45. What happens when babies play footsie with a 45? Toxic babies play footsie with a 45. They shoot themselves through the head. Yep, this one's getting ready. So we're thinking we got inverted HVF structure building on the right shoulder, as I illustrated, of the macro. Your monarch head and shoulders has already triggered with that sell off there. So that is your high king's crown, first of the first in a reversal. Now you got to, I want to remind you that this is major overperformance bank in a screwed overall sector that is universally screwed at the auto loans level, at the subprime credit level, in all the banks. Yet this one has escaped for now with a higher rating. Is scandal ridden, had 2 CEOs thrown out in 3 years, has withheld bonuses and payments and all sorts of elements, is trying to bring its risk book under control and centralize it back in, all sorts of things. What is it doing up here, you might ask? Maybe the shoe is waiting to drop and the key will be in the earnings. You don't rein back all your lending books, stop your staff from stealing, essentially by getting points for creating accounts that don't exist, and still turn out the same numbers. Suddenly they don't look so good anymore once you found out how big they've been cheating. So let's drop into the left half of this. As we always do our analysis, we go daily and we'll swing you through. You will learn, once you're with me, all about broadening structures and how they can be traded. Yes, the megaphone, that is a megaphone on a selling pole there. You'll learn how it could have been traded, and you could have been early into this. My guys are early into this that want to be in it. And this is where we're at. So this is the structure. There's the neckline. Lots of targets were set here from this performing downside along, and this is broadening structure. Yes, you'll learn how we use that, but that is premium content and brand new, by the way. You won't find it anywhere else. We're writing new technical analysis that is required for volatility based patterns, both where they constrict and where they broaden, and that is bespoke to Francis Hunt and the HVF method and the community and all their wonderful adherents. Anyway, that little pitch aside. So there is something going on here that will see, in my opinion, a break to the downside. You may get a final protect rally out of this. So my guesstimation is there are a couple of things. You could break literally from this point. You may get a flag-like rally or a very low volatility period just within that broadening structure, which sits on the same grind line here, which is a weak attempt at dip buying to hold this up in an environment where the tops are coming down, 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 squeezy, squeezy, Japanesey cutting from the top. Off go their heads, off go their hair. You see it happen to me. Watch what's happening now to Wells. You got to learn to duck real fast, because this baby can go with a small bear flag like this. P off the roof pattern. Yep. Go convex and largely down. So that's what we're calling. Let's go back up to those bigger time frames and give you some numbers. So here you're getting a free trade straight out of the premium section. Once again, this is our call. You got to decide where to put stops. If you want to be conservative, you can go with a stop somewhere here. I'll put this in red for stops up top there. You should not easily run. Hey, give me the pen. Bastardo. Yep, I'm learning. I'm still learning, as you can see. Go away. We don't want the menu. So that would be over there. That would be over there, which is roughly 49.7. I would think that you'd be able to get entries a little higher than this point over here. We've already done so. You could have been trimming the tops with us here and on that these highs, but you would still be able to get in fairly well and get a pretty decent risk reward. So that would be your risk there. And if you could enter just below 48, could have risk there. That's how big it would be. And what are you playing for? So you can write that down, 49.75 as stop loss. Entry short. Yes, we are shorters. Entry short, you might be able to get the right side of 46. So somewhere between 46, 46.5 before 47. Maybe let's just say 46.5. There you go. And where could you target? Well, I'm going to take you on a journey back up again. I'm not going to bother dropping the time frame any further. I'm going to take you on a journey back up and we will show you. I think this stock overall is grossly overvalued relative to the others. That is why I expect our friend Wazza is buying Bank of America, which is far less prone to those consumer finance-based scandals. They all have the same balance sheet issues, but probably maybe less prolific also in the subprime auto. This is the second biggest of the lot at the end of the day. So I would close at 23, 50% to 60%, maybe 60% in this case. Target 23.69. There you go, you've seen it. So you're in at 46.50. You've got $3.25, and then you're looking for that. And I would then overperformance. I would expect, with the Great Reset being what it will be potentially, that in actual fact, in due course as this rolls out, you will run the subprime low and some further down. Now, where is that subprime low? You might see it roughly at the 750. How about them apples? Would you like to short a stock from 46 to 7? Would you like to say to your pals, would you like to see your P&L sing as you take a market cap decimation below, just under the 50 mark at 46.50, all the way down to 7s? 7 sevens are 49. You would have lost 6/7 of that market cap. And no, that's not the equity I'm talking about. That will come energy and will be your third video later on in the week. So that is your Wells Fargo trade in a nutshell. You might be able to optimize that entry and get it a little higher. I would certainly have a lower stop, but I know how and why with the megaphone trading principles, but that's your safety stop. You can certainly probably bring it tighter once it triggers. There could be a slight return move. I would hold all the way, and as I say, you can go 50 or 60%, and I think it'll be a different economic environment by the time we're down here, and the extra leg downside will be your gravy. And if this is to be what I anticipate it to be, I expect Citigroup, that you saw, will run new lows and will become ward of state. I expect Bank of America will be back down and probably run at subprime lows. And I'm afraid to say this particular equity, I'm going to take the numbers away now, guys, so I hope you got that. Rewatch it if you don't. By the way, for those of you that really see that this is a major bull market in precious metals and that it's real money, if you want to save money on Peter Schiff and Mike Maloney's version, grab the link in the details below. It doesn't cost you any more, the fact that you're using my link, and they give me a small contribution towards that. If you want to say thanks in any way, do that, but it's really about helping yourself. You can invest $50 a month and buy silver in Singapore, gold in London, Zurich, wherever you want it housed, and after you get past the critical size, you can pay and name your bar, and you can collect that bar. In other words, 100% allocated, and it's even allocated before you own enough for a full bar. It's allocated, it's just not named in you, so there is a one-to-one relationship. And it's cheaper than the big players with the YouTube channels. So if you look at this overall chart, there's nothing stopping us seeing this $1 period and lower back in the 90s. These are ward of state. I don't think they'll be allowed to go bust, but it's quite feasible. You could be sub 5 zone with that small residual percentage, and there's overperformance for that to be managed, and we'll check in with you and we'll top you up. If you've seen my Tilray clip, which I said, look, it's a strong tip, I think it's going wrong for it, you'll know we do get these big calls with massive market caps. Right, we like big calls, we like big risk rewards. We like the reward to be asymmetrically large to relatively tight risk. And it's a ballsy thing to do. But you'll also know that when you want to do ballsy things with really big rewards and tight risks, the probability of outcome is also reduced, but not necessarily in proportion to the gain you will be potentially getting if accurate. And that's the key thing. That's the inefficiency that we exploit. So now you've had it from me, a little bit of fundamental narrative so that you got the story, you've got the chart, you've got the idea, you've got a head and shoulder, you've got a nestled monarch top of the tree head and shoulder that is already in a macro head and shoulder that literally you're in the right shoulder, plus you've probably got inverted HVF structure forming in that right shoulder, which is classic after a falling wedge into the left shoulder that is a lot bulkier and went a lot higher, and you've got a broadening megaphone type structure on a lower time frame, all desperate to hold this line. That is where you're at. Is the domino and the final shoe to drop? I don't know, but I feel I've got a decent enough shout, and that the reward is going to be more than making up for the risk of me being incorrect in the call. Okay, enjoy. That's your Wells Fargo. Grab your gold, buy $50 a week or month, grab a silver, it'll go up even quicker. $50 a week or a month or whatever you can afford. You can obviously do more and accumulate. Your investing will often bail out your crap trading. You'll get emotional, you'll get shaken out with your trading because you're not sizing right. You're investing where you hodl your way through a bull trend in real money that could take you through the reset. It's going to serve you well. Hit the link below. Serve yourself, and you love me at the same time. Love you long time for doing so. Enjoy the trade, and see you on the other side when you nail it. Remember stops, remember sizing. Do the maths first. Okay, catch you all later, guys. Thanks for watching, and as I say, entertainment purposes only. This is not a recommendation. This is me talking aloud about one of our many trades in our awesome sniper community. Thanks for watching.